Okay, so I will be underwriting the 6-unit property. Again, this is not to tell you whether it's good property or not, but rather what it takes to qualify in order to get approved for a loan here, which is honestly two different things. So I made this little calculator. You can get it for free on my website, lamortgagedude.com/DSCR-calculator. First things first is the purchase price, $2,525, $2.525 million. And this, one too many zeros, 25 million for a 6-unit, maybe in 10 years when inflation's way out of control, more than it already is. 2336, let's see, 6 units. And the actual rent for that for the month is $11,060. So this makes it really easy for me because now I don't know how to break out a calculator and figure out how much each of those units are renting for. And the one vacant unit is supposedly going for $4,800. Now the vacancy discount, when doing this, some lenders on vacant units, they will either credit you up to 100% of the market rent, or they'll only credit you up to 75% of the market rent. So it really depends on which investor and lender you're working with. Just to be conservative, I'm going to calculate it at 75%, because if it calculates at 75% and we find an investor that's willing to do 100%, well, you're still golden. You'll also notice the occupancy rate is 83.3% here. When doing Fannie Mae, Freddie Mac, SBL loans, or bank loans for commercial multifamilies, they have a minimum occupancy required of 90%. 90%, that means you have, on a 6-unit property, you would have to have 0 units vacant. If you have even 1 unit vacant, you will not qualify. Property taxes have been filled in automatically and divided by 12 to get us monthly operating expenses. On landlord insurance, that's $550 a month. So let's see what that looks like. 550 times 12, that's $6,600, or about $1,100 per unit, which lines up with my last purchase in this space and in this area. Property management is actually 0, since it'll be self-managed. And all those other things, since there are no common areas, it doesn't really matter. So when underwriting a commercial multifamily deal, whether as a DSCR loan or a Fannie Mae, Freddie Mac small balance loan, or even a bank loan, or even a CMBS loan, what happens is we need to look at the DSCR ratio in order to qualify. And different types of loans have different minimum thresholds. For a DSCR loan, just like a normal DSCR loan, you need a minimum DSCR ratio of 1.0. In order to get 1.0 on this property, you're going to have to put 35% down. Now, on DSCR loans, we go as high as 80% on 1 to 4 units and up to 75% LTV on 5 to 8 units. But you can see here that at 75% or 25% down, your DSCR ratio is 0.89. So it doesn't hit that threshold. And the only way to make it hit that threshold, 1.0, is to put 35% down on this property. And with a Fannie Mae, Freddie Mac small balance loan, SBL loan, or a bank loan like from Chase or Bank of America, they want to see at least a 1.2 to a 1.25 DSCR ratio. And not only that, they base it off of net income. We base it off of gross rents. So gross rents means this entire amount here, whereas they are basing it off of this amount here, the net operating income. The good news is if you put 46% down or have an LTV of 54%, you're cash flowing. With us, you're cash flowing $4 a month. And you're going, well, that sucks. Yeah, it does. But the other interesting benefit of doing a DSCR loan is that we can go interest only. And when we go interest only, we can actually get a better DSCR ratio right here at a smaller down payment, because when we calculate our DSCR ratio, we only count the total debt service. And if you have an interest-only loan, you do not have to pay any principal payments for a set period of time. As a result, you can qualify for this property with much less money down, as well as pocket more cash at the end of the day. So let's see, 433. I don't know what happened there, that's weird. No, you're still losing money there. Let's see, 1.03. There we go, 1.03, which is what this was at. So you're still cash flowing more here, but that's because you put way more money down. Now, the other interesting thing about this is if you have a lower interest rate, let's say you have a 6.5 or 6.75% interest rate, right? That means your monthly payments will be lower. But that also means you can put down less money, because with smaller monthly payments, your DSCR ratio goes up. So it was originally 1.03, but now it's 1.06, and you still qualify for this loan. But if we look at our rate sheet here, what we find is that at different DSCR ratios and at different down payment thresholds, you actually get different interest rates. So if you're at a 1.0 and between a 1.0 and 1.1, the lowest interest rate you can hope for and buy down is an 8.125. In order to see a 6.125% interest rate, you have to be at a 1.1 DSCR ratio. So let's see what that would look like here. 6.125. And you hit it. That's actually pretty amazing. So for 25% down, you get a $300,000 discount on your down payment with a small balance loan from Fannie Mae, Freddie Mac. You had to put down $950,000. Over here, you only had to put down $630,000. Your cash flow is relatively the same, $1,814 versus $1,906. And your monthly payments are slightly more. But again, this is interest only, and these payments here are fully amortized. But you'll notice that your down payment, your max LTV went up. That means your down payment went down a little from 4% and went to 62%. That means your down payment went down from 46% to 38%. So this is me underwriting. This is a tool I made. It's free to use. You can go to my website, and it does not cost you anything to use. You don't have to enter any information to use it. It's just there. And you can pretty much underwrite any property by entering the basic information. Now, if you want a more realistic outcome here, all you have to do is actually enter what it would cost to manage these properties. So let's say water would probably cost about, I don't know, $100 a month just for the common areas, watering the lawns and everything. Gas in the common areas, not too sure, maybe a $0. Electricity, I'd guess pretty low. Trash pickup, that might be an expense, so let's say $250. Pest control, I've seen that get up there pretty high, so $180 a month regularly. Legal, depending on the amount of evictions you have, you just basically take what it costs you in a whole year and divide that by 12. So maybe it costs you, let's say, $200 or $2,400 in a year. That's not too bad. Advertising, maybe you spend nothing on advertising. You just post on apartments.com or Craigslist or Facebook and fill up pretty quickly. Now your net operating income is $8,000 a month, meaning everything you have to pay after that comes out of this, even if you're doing a DSCR loan. So everything else stayed the same. The interest rate stayed the same, loan terms stayed the same, and interest only stayed the same. The DSCR ratio only takes a look at, on a DSCR loan, only takes a look at gross qualified rents and divides it by the monthly debt obligations, which in this case would be the principal and interest payments, as well as property taxes and landlord insurance. And that's it. It does not care about anything else in order to qualify you for the loan, but that doesn't mean you will cash flow, because you still got to pay all these other expenses here, all these monthly operating expenses, on top of the property taxes and landlord insurance. So you're in the hole here, $1,605 at 25% down. With a Fannie Mae, Freddie Mac small balance loan, you have to hit a DSCR ratio of 1.2 after you take out all your operating expenses. It looks at it at your net operating income divided by the monthly debt service on the loan. And if that equals to 1.2 or higher, you're approved. And that guarantees you have cash flow here. But you have to put a pretty big down payment in order to get that. The other thing about these loans is that while they may have interest-only periods, they still calculate it based on the fully amortized monthly payment. So your down payment ends up being bigger, 56% in this case, or a total of $1.4 million on a $2.5 million building. If you want to see how much it would take to cash flow the same amount here, you would just enter that in there, 1341. Okay, so I guess that's not letting me do it for some reason. I'll fix that. But let's see what it looks like here. So on this loan, in order to get into the same ballpark, you're saving about $200,000 in down payment. Your DSCR ratio doesn't really matter, because what we're looking at is comparing the monthly payments and the net cash flow here. So with the DSCR loan, you can actually, if you put down, Seems like something got screwed up there. So we want right there. So with the DSCR loan, you can put a smaller down payment. You can make it interest only, and your monthly payment will be roughly the same as a bank loan at the same interest rate or same ballpark, and your cash flow will be also roughly the same. Now, last time I did this, Chase actually had an interest rate at 5.8%. The lowest we could get to back then was a 5.99%. Accommodating for drops in the market since then, cuts in the rate since then. Let's say this is a 5.75, okay? And we're still trying to get the same interest rate now, or the same monthly cash flow. So now you're still saving $200,000 in down payment, and your monthly payments are again roughly the same, and your cash flow is roughly the same. So when underwriting a loan, what I'm trying to do is just make sure that at minimum this hits a 1.1. A 1.0. That's it. That's all I care about. I just want to see a 1.0 here at minimum. Given this interest rate, I can get an interest only option or an interest only loan. I can get this property to a 1.19. Now let's see what happens at a 1.19. To unlock these rates, you're at 1.15, but that means you've already unlocked this. What you'll notice here also is besides the interest rate, you'll see a slash and a number 100.2.50, 99.750, 99.125, 96, 95. What that means is that at 100 even, 100.000, that's the par rate. That's the given interest rate. That's your basic interest rate at that DSCR ratio and down payment. Now, if you want a lower interest rate, you can actually buy it down. That's when numbers go below 100. So 99.513. That means you had to pay roughly 99.513 minus 100, 0.487 points, or 0.487% of the loan amount. So the loan amount here is $2,525,000 minus 631,250. So that amount, 1.89 million times 0.487%. So for $10,000, you can lower your interest rate from 8.25 to 8.125. On the other hand, you can also lower it to 5.75% for 5 points. Now that's going to look pretty expensive. So let's see, 5 points, 5% time. Let me clear that again and set that up. So we had a $1.89 million loan times 5 points or 5% of that loan amount. So for $94,500, almost $100,000, you can buy yourself a 5.75% interest rate. And you're going to go, why would I buy the interest rate and throw that money away? Well, in my opinion, you're only throwing money away if you get nothing of value back for it. And here, the thing of value that you're getting back for it is several things. One, you're getting a much lower interest rate, something on par with the banks. Two, you're saving significantly more down payment, roughly $700,000. So for $100,000, you're saving $700,000. And yeah, that $700,000 is going towards equity in the same building, but you can buy multiple buildings. If you had $700,000, you could buy a second building. Let's say you wanted to buy another apartment building or home, flat out cash. You can do that for about $700,000, depending on the area that you're looking. So you get one building for $631,000. Yeah, it's not cash flowing, and this one is. But let's say, what happens if you just try to break even here? Let's do it at zero, right? That's close enough to zero. So that's $48,000, $850 versus $1,375, $1.375 million. So you're looking at what? A difference of about $500,000. That $500,000 can serve as a down payment on another building, and now you're gaining on the equity appreciation in two buildings instead of one. Let's say you still want to balance it out, right? Well, now you're saving $200,000, but and now you got to buy that interest rate down, right? So for another $100,000, so you're saving $100,000 between this and this to get the same monthly payment. If you just look at it as cash out of your pocket, that's what you end up with. So that's enough of this building that I just underwrote in a fairly short amount of time compared to the video I did yesterday. But hopefully it helps you understand what I'm looking at as a loan officer and trying to qualify a building. Again, I do not promise that these are good investments. I just promise that I can show you what it takes to qualify for a loan. Maybe as a buyer you have a sentimental attachment to that building. Maybe you want to break it down and build something bigger there, at which point none of these things end up mattering, whether you're using equity or interest rate or buying down the interest rate.